Hello and welcome to VMGA TV. In this video, we're going to talk about the different types of markets and market structures. Understanding these market structures is essential for businesses, investors, and policymakers because it helps them to make informed decisions about pricing, production, and competition. There are four main types of market structures: perfect competition, monopolistic competition, oligopoly, and monopoly. Let's take a closer look at each of these market structures. Perfect competition is a theoretical market structure where there are numerous buyers and sellers of a homogeneous product. There are no barriers to entry or exit, and all firms are price takers, meaning they have no control over the price of the product. In a perfect competition market, firms can only compete on the basis of price and quality. Monopolistic competition is a market structure where there are numerous sellers of a differentiated product. In this market, firms have some degree of control over the price of their product because they can differentiate their product from others. However, there are still low barriers to entry and exit, which means that firms can enter or leave the market easily. An oligopoly is a market structure where a few large firms dominate the market. These firms can influence the price of the product because they control a significant share of the market. Entry barriers are high in an oligopoly market, which makes it difficult for new firms to enter and compete with existing firms. A monopoly is a market structure where a single firm dominates the market. This firm has complete control over the price of the product and can set prices at a level that maximizes its profits. Entry barriers are very high in a monopoly market, which means that new firms cannot enter the market and compete with the existing firm. Let's look at some real-world examples of each market structure. The agricultural market is an example of perfect competition because there are many farmers who grow the same crops, and the price is determined by the market forces of supply and demand. The coffee market is an example of monopolistic competition because there are many coffee shops that sell different types of coffee, and they can differentiate their products from others. The automobile market is an example of an oligopoly because a few large firms dominate the market, and they can influence the price of the product. Finally, the utility market is an example of a monopoly because there is usually only one utility company that provides electricity, gas, or water to a particular area. Each market structure has its advantages and disadvantages. Perfect competition promotes efficiency and low prices, but it can lead to low profits and a lack of innovation. Monopolistic competition allows firms to differentiate their products, but it can lead to higher prices and less efficiency. Oligopoly can lead to economies of scale and innovation, but it can also lead to collusion and higher prices. Monopoly can lead to economies of scale and high profits, but it can also lead to higher prices and lower quality products. In conclusion, understanding the different types of market structures is essential for businesses, investors, and policymakers. Each market structure has its advantages and disadvantages, and it's important to consider these factors when making decisions about pricing, production, and competition. We hope you found this video informative and helpful. Thanks for watching, and we'll see you in the next video.